America First Legal filed a shareholder suit against Target this week, alleging that the company's decision to cater to the radical left and their LGBTQ agenda has cost shareholders billions of dollars. In May, shares were trading at $160 a share. Now, May, right before Pride Month, where Target went all out with their tuck-friendly swimsuits and their clothing that was designed by self-described Satanists, where in May, shares were trading at $160 a share. They're now trading at $130 a share. At one point, Target lost $15 billion in market cap. It was over $74 billion before the controversy, and it now sits at $60.3 billion. Now, the company has received multiple downgrades from analysts who follow the stock and follow the success or failure of the company. And part of the reason that they listed for the downgrades, recent company controversies, as well as diminishing store traffic. So after all of this nonsense that Target participated in, I mean, I don't really know what in the world LGBTQ agenda has to do with selling clothes and groceries and, consumer products that Target sells. I mean, if you look at the population in general, I think it's less 2% or maybe definitely less than 5% of the population that identifies as LGBTQ. So, I mean, is it so important to cater to this one segment of the population and to, like we saw with Bud Light too, and offend their base? So diminishing store traffic means that people are boycotting the store because they're taking a stand in the culture war. So one of the reasons that we do biblically responsible investing, number one, so that we don't support the garbage and the lies that are perpetuated when companies use shareholder money to push causes that don't align with Christian values. And number two, it's proving to be bad for business. I mean, the stewardship responsibility that a corporation has is to steward shareholder value. So they are to take the money that the owners of the company has invested, and they're to generate a return for the shareholders. Part of that return is an increasing share price. We can see that these decisions that Target has made to pander to the left has resulted in lowering their bottom line. Disney is another example. Disney is on track for $5.5 billion in cost cutting. The company fell behind analyst projection for U.S. subscribers to Disney Plus. Shares fell about 1% after hours following publication of those results, and the company said that it's going to have to, as a result of all that, going to have to cut $5.5 billion in cost. Disney Plus lost 300,000 subscribers in the United States and Canada in the most recent quarter. An ominous sign for the studio as it continues to pour billions of dollars into new streaming content that is just flopping with the viewers. So, more, Disney's agenda to promote the LGBTQ plus, trend is proving to be a downfall in their business as well.